Thank you for being here today and thank you for listening. I'm Adrian Helfert, our CIO of Multi-Asset and Alternatives and Wealth. And recently I spent some time with our investors talking about an outlook, an elongated outlook where I give 45 minutes to an hour. I'll try and keep this shorter. I just wanted to give you some ideas of things we're looking at for the future, some areas of opportunity, and our overall outlook and things that might change that outlook over time. One of the key pieces was we broke it down into 6 key themes that we are watching right now. The first of those themes is deregulation. Deregulation is pointed towards accelerated business growth, especially in the area of small and mid cap. And I'll step back for a second and say, if you listen to this entire video and you walk away with one thing, it is we believe that there is an opportunity in small cap and mid cap stocks that are underappreciated or undervalued relative to larger cap peers, i.e., we could see a broadening of the overall equity market from several things that are happening. Deregulation is one of the key pieces of that puzzle of cutting the cost to small and mid-sized companies for operating that have previously had higher cost of regulation and oversight and less of an ability to actually make quick changes to adapt to the business environment, which also leads to areas like mergers and acquisitions, M&A. M&A has been muted, just like initial public offerings or IPOs have been muted over the last several years, in part because of regulation and the extended time it takes for an approval for a transaction to happen, meaning it's less likely for companies to go through a transaction because of the changing business environment by the time that they actually see the approval of the merger. So we could see an increased and an enhanced M&A environment. We could see lower cost to small and mid-sized companies, especially on deregulation. We could see advancements in other areas from deregulation. It comes with risk as well, but this is the drive that the administration incoming is pushing for, is accelerating business growth by reducing that cost to companies. One of the second key themes is trade turmoil. I don't need to spend too much more time on this one because it's in the news every single day, 7 days a week, of areas like tariffs that could impact inflation metrics, it could impact growth metrics, and we're using it for one of the first times ever as a blunt instrument to control for non-economic outcomes like the movement of fentanyl across borders and immigration using an economic tool of the blunt tool of tariffs. Trade turmoil is something that will be a key feature of potentially right-sizing or reducing, I should say, the trade deficit of the United States to other countries. That comes with risk as well of supply chain risk and lack of movement of goods across borders and potentially, of course, increased prices. The third key theme is manufacturing renaissance. Kind of goes hand in hand with trade turmoil in the sense of we have a large manufacturing base in the United States that is poised to become more competitive on pricing for their goods, for their input goods, potentially even exporting as well, if we see tariffs at the borders for input goods coming from other countries. A manufacturing renaissance would help a specific sector, a specific area and style, which is especially those small cap and mid-sized companies that are producing, for instance, ball bearings wrapped in graphite for helicopters. Small areas that make up a meaningful amount of our job growth, of our consumer sentiment, that could lead to an increase in more productivity coming from the United States itself for input goods for manufacturing. The fourth key theme is powering the future. Suffice it to say, we don't have enough power simply coming out of the ground to fully power our future if we're going to create humanoid robots and autonomous cars and all of the impacts, the implications of the technological innovation that we have seen recently. So we are looking for energy infrastructure investments to help build the energy needs of the future that are significant and more than is currently available. The fifth key theme is commercial real estate. Commercial real estate, of course, has been on a significant downturn since the old word COVID now. It's hard to believe we're still talking about it in some sense, but increasingly we are seeing the metrics that say employees are coming back to the office and the push for that. That leads to two things, really. That leads to more commercial real estate being used, of office space being used. It's also urbanization. Generally, those commercial real estate buildings are in urban areas. So we see a knock-on impact that's positive to consumer spending for retail businesses. But commercial real estate, of course, prices, we believe, are poised to rebound some. And the metrics that we are seeing point to positivity in the area more than a concern that we're going to see a complete repurposing of buildings and a downturn in valuations in the area. The sixth and final, of course, is the impact of all this. The knock-on impact of many of these things are we've seen small and mid-sized businesses that have lagged in their pricing. They've lagged in their valuation, especially the mega cap large tech businesses that have driven this extraordinary return of 25% plus of the S&P 500 over the last 2 years. Over the last 15 years, you've seen an average S&P rise of 16.5% year on year. It's pretty extraordinary, and it's more driven by large cap than small cap businesses that have been negatively impacted, or I should say are poised to see a positive impact from a manufacturing renaissance from deregulation. Let's look at just one of the metrics on that I found really important. When we talk about deregulation, how do you measure that? How do you think about that? Certainly, if you've heard me speak before about the vicious and virtuous cycle, it often starts with confidence, especially consumer confidence, but let's look at small business confidence. You can see at the beginning of the last Trump administration in 2016, a big spike. And then at the beginning of this administration, that's one of their key foundations, is to help small businesses. Small businesses, of course, small business growth is around 60 to 65% of new jobs created as well. That helps that consumer confidence measure. You see that spike at the end. And what that tells us is CFOs and CEOs are looking toward the positive environment going forward. They're looking for that lower regulation cost, potentially deploying that into hiring more employees, to buying more machines, to make more widgets to facilitate their supply lines. That's a positive indication that we have recently seen. Next is, if we look at the trade turmoil, it's very much plays into, yes, we are on a trade deficit. Of course, our trade deficit and our trade as a whole of the economy is lower than others, and it gives us the ability to use this as an instrument for negotiation. Our trade as a portion of GDP is around 24%. Contrast that with Mexico, which is somewhere around 75%. Canada is around 70%. China is almost 40% trade as a percentage of their GDP. That gives us the ability a little bit to use this as a negotiating tool because it's important to other countries more than it is to us. You see this a little bit here this is a chart that you could imagine we're sitting down, if we were to have one single chart and sit across a negotiating table with a trade partner and saying, we're negative trade surplus. We are generally buying other goods from you and other nations. This is what we are looking to find ways to either make our companies in the United States more price competitive, or to find ways to offset that with growth in other areas of our economy for transactional behavior, things like are happening in the chip area now. So something to watch for us. Next is, of course, I'll skip forward and say we're looking, of course, at the amount of energy that is expected or forecast to supply the needs of all this incremental power generation that we expect from artificial intelligence, from, as I say, autonomous cars and robotics and increased utility in manufacturing, and all of these things that actually we do really need. They might take some jobs, hopefully they create other jobs, but we certainly need the enhanced productivity in our economy to offset some of the inflationary policies in other areas. So we expect actually a push for this increased productivity, this increased utility of technological innovation that comes with an increased need for energy, which means we're going to be building more infrastructure. We're going to see more investment in infrastructure, and we expect more return on investment from that infrastructure in the future. That's an area to look for investment. Finally, to close this, we're looking, of course, at the compilation of this pointing to an area of opportunity in small and mid-cap stocks that could take the lead. Some would say finally, because we've been looking at this potential and watching this extraordinary outperformance, especially of the now well-known Magnificent Seven stocks like the larger ones that, of course, maybe just look at that very bottom line on all the numbers on this slide, the correlation with U.S. manufacturing. Small and mid-cap stocks are more correlated with U.S. manufacturing, and if one of our outcomes is that we expect better manufacturing supply from the United States, a manufacturing renaissance, then one of the biggest areas of benefit would be the small and mid-cap stocks. Leaving you with just a bit of a flavor of what we talked about at our annual outlook. Of course, there were many other areas of interest, many other questions, but just skipping forward a little bit, when we talk about our capital markets outlook once a month, we publish a capital markets outlook, and we talk about especially the asset class outlooks, and we break it down just to the equity market, the credit market, the interest rate market, that's government bonds, and then we look at individual thematics and sectors that would benefit at a high level. For now, suffice it to say, the equity market outlook, we are positive. One of the biggest metrics there is still the Federal Reserve, that is in a mode of saying they can ease. Maybe that the ability to ease from a higher rate is more important than will they actually do so. Right now, they're only expected to ease about 2 more times until the end of 2026. So not much more, but it's the ability to suppress volatility by provisioning accommodation to the market if they need to do so, that they have verbally committed to, that is important. That's a positive backdrop. And while we have inflated valuations in many sectors, and if you were to just look at the S&P 500, we are at a significantly elevated valuation. There are other areas that have not appreciated as much, and we see opportunities, especially for selection in those areas. And of course, I pointed to the small and mid-cap stocks of those. The credit outlook, a little bit more negative. There are areas of opportunity, and oftentimes now it's a discussion of how high yields are, not just how much extra compensation or spread you get for the default risk. But we have to look at that on just credit. You're not compensated very much for the possibility of default of individual companies. That spread is low. And so we are more careful on our investment in credit. Those are asymmetric risk and reward investments. And we are careful to look to those that have lesser downside than the upside. The rates outlook then is just where we then look at the government bond market or the risk-free market and say, do we expect rates to go up or down simplistically? And we do believe that if some of these policies make their way through, we should expect to see rates either range bound, in which case you're earning a nice little carry or an interest relative to history, or we could see negative growth impacts. It still forms a good offset to other things happening negatively in the economy, so we think it is attractive to hold interest rates here. I'll skip forward a little bit and say we've got a lot of questions during our presentation. Some of the major questions that we would get, we'd enjoy hearing from you, our potential investors as well. Areas like artificial intelligence, what's next? Should I buy NVIDIA? What's the impact of DeepSeek? That was one of the bigger questions. Does DeepSeek mean that those energy needs that you point to are lessened because the same search for artificial intelligence requires less? For sure, we do not believe that. We believe that actually this accelerates that technological innovation, that accelerates the move into areas that could be the robotics and the autonomous cars. If anything, it changes the narrative for some companies of saying, can this artificial intelligence engine pass the bar exam or have a good score on the MCAT versus DeepSeek Now changing that conversation to saying, actually, how efficiently can it pass the bar exam? That's a new measure of success. That is a good thing. It is something that will impact some of the conversation for the need for advanced chips that NVIDIA produces. That was one reason why their stock reacted so negatively to the outcome. But at the same time, we do believe it will advance even faster some of the technological innovation. And of course, we get questions around tactical asset allocation. How tactical should I be? Should I just invest in the S&P 500? Gosh, the S&P 500 has been up 25% over that over the last 2 years. It's at 16.5% over the last 15 years. Hard not to go, gosh, I'm just going to put my chips on the table and bury my eyes for that. There are a lot of benefits to reducing your volatility and reducing the potential for a downside growth reaction by being very tactical in this environment. If you listen to one thing, it is around pointing to the opportunity set that is under the surface of just the S&P 500. One of those opportunity sets being mid-cap and small-cap stocks. Another of those is simply being the selection that is there in those companies that are going to find good revenue paths and margin expansion paths from this new pharmaceutical innovation, new technological innovation. So there are a lot of benefits to being able to be tactical and realize some of those valuations. I often talk about when you squeeze the balloon, where does the air come out, and chasing the valuation where it exists. Tactical asset allocation and this standpoint will give you that opportunity. I'll stop there. We did a much longer presentation. I would be very happy to answer further questions, or if you have an interest in this presentation that we have just given you, it's a longer one that we're happy to send to you at request. Otherwise, I thank you for listening. I hope to see you soon.